5 tips to start investing in stocks on a budget. Hey guys, today we're going to list 5 tips to start investing in stocks on a budget. Let's get right into it. Number 1. Create an investment budget. Naturally, the stocks you buy will be influenced in part by how much money you have to invest. You should plan ahead of time how much money you are willing to spend. If you intend to make investing a regular part of your budget, set aside a specific amount of your monthly budget for stock investment. Even if this is a small sum, investing on a regular basis is a great way to learn how the stock market works while working toward larger long-term goals. Your financial situation should obviously be the first factor determining your monthly investment budget. Only invest what you can afford. Do not invest at the expense of your current financial obligations. Create a budget that fits your income, monthly household budget, savings, debt obligations, and current lifestyle expectations. Investing in an exchange-traded fund or a mutual fund is the most convenient way to invest a small amount of money in a diverse range of stocks. These funds are large stock collections. As an investor, you can purchase shares in a mutual fund, which will make you a shareholder in a diverse range of companies chosen by your fund managers. In a later section, we'll go over the differences between stocks and funds in greater detail. Number 2. Select an account type. This leads us to the next step, which is to select a brokerage account. Discount-level companies provide a variety of accounts designed for affordability, accessibility, and even education. The Motley Fool recommends TD Ameritrade, E-Trade, and Charles Schwab, which all make it simple to open a new trading account and get started. Each of these businesses also make it simple to get started online. Another factor to consider when deciding which type of account is best for you is your financial situation. You have the option of using a traditional investment account or a robo-advisor. NerdWallet says, robo-advisor services provide complete investment management. These companies will ask you about your investing goals during the onboarding process and then build you a portfolio designed to achieve those aims. This may sound expensive, but the management fees here are generally a fraction of the cost of what a human investment manager would charge. Most robo-advisors charge about 0.25% of your account balance. And yes, you can also get an IRA at a robo-advisor if you wish. If you're just getting started, a robo-advisor could be a good option. This is a great way to learn how to prioritize your investment decisions while also making some smart investments. Number 3. Understand the distinctions between stocks and mutual funds. You should understand what you're buying before making a purchase. This primarily implies that you must understand the distinction between stocks and funds. Stocks are ownership stakes in specific companies. If you truly believe in a company and see its potential for growth, this is a good way to invest. A successful and growing company may reward you with a high-return investment. When you invest in a single stock, you should expect to see potentially dramatic price swings as events impact both the company and the broader market. Mutual funds and exchange-traded funds are simply collections of stocks. When you buy a mutual fund, you are purchasing small portions of many different stocks. This is often regarded as a better long-term investment strategy because funds are not subject to the same dramatic price swings as individual stocks. While funds will fluctuate in response to changes in the economy and market, they will be less affected by events within individual companies. You should also keep in mind that the vast majority of financial advisors will strongly advise you to prioritize funds over stocks. By investing a larger portion of your budget in these funds, you will experience less long-term volatility. According to NerdWallet, a well-balanced retirement portfolio will invest roughly 80% of your investment budget in funds. The majority of the remaining funds could be invested in bond funds, which are similar to ETFs, but have more stability. Individual stock investments, according to financial advisors, should make up a small portion of your portfolio, especially if you are new to the market. Number 4. Pay off your debts. Now that we've completed the preliminary steps, it's time to take a step back and prepare to maximize the effectiveness of your investment strategy. Simply put, before you start investing, you must pay off your debts. Any outstanding credit card balances that you carry from month to month, as well as burdensome medical bills and debts that you manage on an installment basis, should be addressed. Before you can truly begin to see the value of your investments, you must first balance your own household budget, which begins with reducing the amount of debt that is impeding your monthly finances. If you are already debt-free, you can proceed to the next step. If not, it's time to reconsider how you spend your money. High credit card balances can incur high monthly interest charges, which can quickly outweigh any modest gains in the stock market. In other words, your household's bottom line would be better served if you spent that money first on debt reduction. Once this is completed, you'll be able to begin reaping the benefits of your investments. Number 5. Manage your investments actively. Another way to capitalize on opportunities while minimizing risk is to become an active, engaged, and educated trader. First and foremost, recognize that the market will be volatile. The value of your investments will fluctuate, and patience is your most valuable asset when it comes to long-term investments such as retirement funds and exchange-traded funds. Despite short-term market volatility, long-term gains will be realized. That's all for today, and we'll be sure to catch you all in the next one.